Welcome to Agoracom Small Cap Breaking News, your daily go-to source for the best small cap headlines for over 65 million investors since 2007.
Love that energy to kick things off.
You have to bring the energy today because, honestly, we have an incredible lineup. What do a consumer Wildfire app, a digital 3D couch, and an underground electromagnetic radar all have in common?
It sounds like the setup to a really strange joke.
Right. But today, on the deep dive, we are looking at 5 companies that have cracked the exact same economic secret.
And that secret is how to turn raw assets into actual, bankable revenue.
Exactly. Bankable revenue.
It is a critical distinction to make because when you look at the headlines hitting the wire today, the underlying theme is the mechanics of value creation.
The actual nuts and bolts of it.
Yeah. Whether a company is, say, mining digital data to build high-margin software subscriptions, or they're physically drilling the earth for high-grade critical minerals, raw potential just isn't enough anymore.
Nobody cares about just potential anymore.
Right. The numbers we are seeing today are the hard indicators of how these companies plan to actually commercialize those assets.
So we are cutting right through the fluff today. We have 5 major breaking press releases across the tech, fintech, and mining sectors.
The heavy hitters.
Yep. We are looking at the hard financial metrics, the specific drilling results, and delivering exactly what you need to decide where to focus your deeper research.
So where are we starting?
Let's jump straight into the tech sector. AISIX Solutions, Inc. just announced the launch of their WildfireScore retail application.
Oh, this is a big one.
It really is. For you taking notes, they trade on the TSX Venture Exchange under the ticker TSXV AISX.
Got it.
They also trade on the OTC under OTC AISXF, and on the Frankfurt Exchange FSE QT7.
So this represents a massive shift in their business model. Up until this morning, AI6 was built entirely around their Wildfire 3.0 API.
And for anyone who doesn't spend their days coding, an API, an application programming interface, is essentially the hidden engine that allows 2 different computers to talk to each other.
Exactly. It's the background plumbing.
Right. And AI6 was strictly selling this to institutional clients like governments and major insurance companies.
The ones who needed massive raw data sets to predict wildfire probability.
Exactly. But today, they are taking that hidden engine and they're putting a steering wheel on it.
I like that analogy.
Thanks. They're launching a direct-to-consumer web app. So everyday Canadians can now just go online, type in a residential address, and instantly get a wildfire risk score and a detailed report for that specific property.
It takes the technology out of the boardroom and puts it directly into the living room.
Exactly. And the CEO, Dr. Gio Roberti, was very clear about the utility here.
What did he say?
He stated in the press release that this app will allow Canadians to make more informed real estate investment decisions in a changing wildfire risk landscape.
Which is, it's an incredibly timely product given the severe climate and fire data we have been tracking over the last few years.
Absolutely. The residential risk profile is shifting rapidly.
It really is. You can't just assume a property is safe anymore.
Okay, let's unpack this. Because I was reading through this release, and there is a glaring omission.
Oh. What did they leave out?
There is absolutely zero mention of pricing. There's no clear monetization strategy laid out for this consumer app.
Ah, I see where you're going.
Right. So if they are giving this tool away or, not immediately charging for it, why build it?
That's the million-dollar question.
Is this just a marketing gimmick, or is there an actual revenue driver here? It's like taking complex military-grade satellite data and putting it into a simple consumer GPS app on your phone. Without a subscription fee, what's the point?
What's fascinating here is you have to look at who the ultimate audience really is.
Okay, who is it?
Yes, on the surface, it is a tool for prospective homebuyers. But even if they don't make a single dollar directly from consumers today, creating the simple, intuitive search bar interface serves a much larger strategic purpose.
Like what?
It acts as a highly visible live demonstration for those massive institutional pilots and requests for proposals they are currently negotiating.
Wait, really? So the consumer app is basically a giant billboard aimed at enterprise buyers?
Precisely. Remember what you said about an API being a hidden engine?
Yeah, totally invisible.
Exactly. In the software world, an insurance executive can't touch an API. They can't see it working.
Right, they just see lines of code.
Exactly. By wrapping this complex military-grade data into a seamless consumer app, AI6 is proving the usability of their underlying engine to the actual big money targets.
Oh, wow. That's clever.
It shows those institutions how easily the data integrates into a user-friendly front end. That live proof of concept is exactly how you close multi-million-dollar enterprise contracts.
That makes complete sense. It's basically the ultimate portfolio piece.
Exactly.
Well, while AISIX is currently building its consumer pipeline, our next company just officially locked in a concrete multi-year enterprise contract to monetize their digital assets.
Let's get into the specifics of this deal.
Nextech3D.ai just signed a 3-year enterprise 3D modeling and augmented reality e-commerce contract valued at approximately $175,000.
Those are solid numbers.
Yeah, their tickers are CSE and TAROTCQB, NEXCF, and FSE1SS.
Always good to get those down.
Let me give you the exact breakdown from the release. This is a US $175,000 total contract, which works out to about US $58,000 a year for 36 months.
Okay, so a steady recurring revenue stream.
Exactly. And in exchange, Nextech3D.ai is using its Airtize 3D platform to cover 2,500 product SKUs.
Which, for those listening, are just individual inventory items in a catalog.
Right, so they are creating the 3D models, hosting them on their servers, and providing the augmented reality visualization.
So a customer shopping online can look at, say, a piece of furniture on their phone and use their camera to project it right into their physical living room.
Exactly, right before they hit the buy button.
It's incredible tech.
It is. And CEO Evan Gappelberg commented directly on how this fits into their broader strategy. He said, and I quote, "While our primary focus remains on scaling our AI-powered event technology platforms, our 3D modeling and AR e-commerce solutions continue to generate additional revenue through subscription-based platform services."
Notice how carefully he distinguishes between their primary focus and the specific contract.
I definitely noticed that. But here's where it gets really interesting.
Lay it on me.
The press release casually drops a massive detail. The estimated gross profit margins on these hosting and platform services are approximately 95%.
95%, that's almost unheard of.
Right. But frankly, I have a pushback here. If the company openly admits on the wire that their primary focus is their event tech ecosystem platforms like EventDex and MapD, isn't this 3D modeling contract a massive distraction?
It sounds like a distraction until you understand the underlying mechanics of AI-assisted production workflows.
Okay, walk me through that.
If we connect this to the bigger picture, historically, if an e-commerce company wanted to turn a flat 2D photograph of a shoe into a fully rotatable 3D augmented reality asset.
They'd have to hire a graphic designer.
Exactly. An expensive human graphic designer to spend hours building wireframes and textures. It was incredibly labor-intensive.
Just a slow and expensive bottleneck.
Precisely. But Nextech3D uses automated AI tools to do that heavy lifting. The software automates the conversion from 2D to 3D.
So it's basically instantaneous.
Yes, and when software automates that, the marginal cost of producing the next 3D model drops to almost zero.
Wow, zero.
Effectively zero, yeah. Once the AI is built, it costs them fractions of a penny to generate the next asset. That is how you achieve a 95% gross margin.
Okay, so it's practically pure profit once the system's running.
Right. So to answer your question, this isn't a distraction from their event tech. It is the financial engine powering it.
Ah,
This ultra-high margin subscription revenue from e-commerce acts as a cash geyser that funds the expensive infrastructure for their primary AI event platforms.
so they're essentially using a highly automated side business to fund their main vision. That is incredibly efficient capital allocation.
It's brilliant, really.
But, if Nextech3D.ai is showing us the power of high-margin subscription models, our next headline shows us what happens when a platform-driven model fully matures and scales into the tens of millions.
We are moving from single product margins to ecosystem-level infrastructure.
We really are. Let's look at Orion Digital. The numbers here are just staggering.
Let's hear them.
The headline reads, Orion Digital accelerates platform strategy as wealth and payments businesses drive growth.
Okay, a strong headline.
They trade on the TSX under the ticker TSXORIO. Now let me fire off these massive figures for you.
Go for it.
Full year 2025 revenue hit $68.6 million. Their wealth platform revenue is up 36% to $14.5 million.
Huge growth.
Right. Meanwhile, their Carta worldwide payments platform processed over $11.1 billion in transaction volume just in Europe.
Wait, $11.1 billion? That proves the company has completely moved past the proof of concept phase.
Absolutely. And their adjusted EBITDA sits at $7.1 million with 70% gross margins.
They are now foundational infrastructure for the financial sector.
They are. CEO David Feller addressed this exact scale in the release. He noted this marks a transition to a platform-driven business model as financial systems become more automated.
Which is where the entire industry is heading.
Exactly. And President Greg Feller confirmed that full-year results exceeded ranges. And get this, their balance sheet is fortified with $41.3 million in cash and investments.
Having $41 million in the bank gives you incredible strategic leverage.
It really does. Now, I have an analogy for this. Orion is effectively the plumbing of the digital economy.
I like that, the plumbing.
Right, because investors don't usually look at the pipes until the water pressure is this strong.
That's a great way to look at it.
But the release specifically points out that subscription and services now make up 62% of their total revenue.
Right.
Over the last couple of years, Orion deliberately exited a bunch of their older, non-core legacy businesses. So my question is, how crucial was that decision to exit those businesses in achieving these 70% gross margins?
It was everything. To understand that, you have to look at what they actually do now. Traditional financial services, the models that rely on proprietary research and manual trading, they're dying.
Because the overhead is just too high.
Exactly. The margins are shrinking rapidly. The future belongs to the automated infrastructure that handles capital allocation and transaction authorization.
The actual mechanics of moving money.
Yes. By shedding that old baggage, Orion freed up the capital to move their entire Carta worldwide payments platform over to Oracle Cloud infrastructure.
What does moving to the cloud actually do for their bottom line, though?
It completely changes the processing speed and cost.
Really?
How
So?
Relying on on-premise physical servers is expensive. It limits how many transactions you can handle at once. By migrating to Oracle Cloud, they can scale their computing power up or down instantly.
Ah, so they aren't paying for server space they aren't using.
Exactly. This allowed them to lean entirely into the authorization layer. That's the exact millisecond of technology that lets banks securely say yes or no when a card is swiped.
That is fascinating.
That cloud migration drastically lowered their cost per transaction. And that is exactly what set them up for their projected $7.7 million to $8 million in adjusted EBITDA for 2026.
Providing the frictionless rails for $11.1 billion in volume and collecting a highly profitable toll along the way.
It's the ultimate toll booth business model.
All right, we are going to pivot the narrative here.
Let's do it.
We have spent the first half of this deep dive looking at how companies extract digital value and process financial layers. Now we are moving to literal extraction.
We are heading underground.
Yes, breaking news in the critical mineral space, where value isn't measured in API calls. It's measured in meters and grade percentages.
Transitioning from digital algorithms to deep physical geology. I love it.
Here's the headline from Tartas and Nickel Corp. Tartas and Nickel intersects 24.6 meters of 0.71% nickel and 0.56% copper at Cambridge.
Okay, solid start.
And it continues, including 6.1 meters of 1.17% nickel and 1.45% copper.
Wow.
For those tracking the symbols, it is CSE, TN, OTCQX, TTSRF, and FSE ATA.
Let's break down that drill data.
So this is from hole KB26210 at their Cambridge project. Zone A hit a massive 24.6-meter interval at 0.71% nickel and 0.56% copper.
Which is a very wide intersection.
It is, but hiding inside that is a much richer core of 6.1 meters grading 1.17% nickel and 1.45% copper.
Those are highly compelling base metal grades, especially with those copper credits alongside the nickel.
CEO Mark Appleby is clearly energized by this. He emphasized his excitement that the deposit, quote, appears to now flare outwards at depth.
Hearing a CEO say a deposit flares outwards is exactly what you want to hear.
Why is that so important?
It suggests the mineralized system might actually be getting wider and more robust the deeper they drill.
That's incredible. And they are currently drilling this deposit below an already existing 622-meter deep shaft.
Oh, taking advantage of incredible historical sunk costs.
Exactly. But, so what does this all mean? Because I was reading the fine print, and it openly admits that the true widths of these intersections are only estimated to be 65% to 80% of the reported downhole lengths.
This raises an important question about how we interpret drill results.
Right, because should investors be adjusting their excitement downward if the true width is smaller?
Not at all. It's just about the physics of drill geometry. Imagine a thick book standing upright on a table.
Okay, I'm picturing it.
That book is your mineral vein. If you drive a drill bit straight down through the top cover to the back cover, the distance the drill travels is its true width.
Because it went straight across.
Right. But geologists rarely hit a vein perfectly straight on. They are usually drilling from an angle, slicing diagonally through that book.
Ah, I see.
Because the drill path is slanted, the distance it travels through the mineralized rock, the downhole length, is physically longer than the actual width of the vein.
Okay, so the physical vein is slightly narrower than the 24 meters reported, but the metal is still there.
Correct. The grades and continuity are what matter most here. They are trying to upgrade their resource estimate from inferred to measured and indicated.
Proving it's bankable data.
Exactly. And the next massive catalyst to watch is their upcoming borehole EM surveys.
Borehole EM, what's that?
Electromagnetic surveys. They lower a probe down the empty drill hole that acts like an underground radar to find hidden sulfide bodies they might have barely missed.
Underground radar. That is just incredible technology.
It's a game changer for mapping out hidden value.
Well, while Tartisan is finding immense value deep below an existing shaft, our final breaking news features a company striking high-grade treasure right near the surface.
The exact opposite end of the geological spectrum.
The headline reads, Cartier Resources discovers new high-grade gold zone at Cadillac Project in Quebec.
Always nice to see high-grade gold in Quebec.
The ticker is TSXV, ECR, and the core drill results from the newly discovered North Simon zone are spectacular. Hole CA26-314 returned 7.1 grams of gold per ton over 8 meters.
That's a great hit over 8 meters.
It gets better. That includes an incredibly rich interval of 38.8 grams per ton over just 1 meter.
Finding nearly 40 grams a ton, even over a narrow 1 meter width, is an exceptional grade.
The VP of Exploration, Ronan Daroff, pointed out that this is the 4th gold sector found in the portal area. And he emphasized it benefits massively from existing road access and historical infrastructure.
Infrastructure, it's the most powerful word in the mining sector.
Right. I mean, finding a high-grade gold vein is fantastic, but finding it just 150 meters from a historical ramp, it's like discovering oil directly beneath a functioning pipeline.
That's a perfect analogy.
So just how much does that proximity to infrastructure alter the actual development economics for them?
It alters the math completely. It all comes down to the initial mining costs.
The CapEx.
Yes, the Cadillac project already boasts over 3 million ounces of gold across measured, indicated, and inferred categories.
So the scale is already proven.
Exactly. But adding near-surface, high-grade ore right next to existing infrastructure drastically lowers potential initial mining costs.
Because they don't have to spend tens of millions digging a new tunnel just to reach the ore.
Precisely. They can access that high-grade rock almost immediately to generate early cash flow.
Wow.
And this could be the exact data point that makes their upcoming 2026 preliminary economic assessment highly attractive to the market.
It fundamentally de-risks the early years of the mine.
It really does.
Well, that wraps up our breaking news deep dive for today. And what a journey.
From the cloud to the underground.
Exactly. From AISIX's consumer data pivot and Nextech's 95% margin tech contracts to Orion's $68 million fintech engine.
And finally, the hard, in-the-ground reality of Tartisan's nickel and Cartier's high-grade gold.
I highly encourage you listening to look up the specific tickers we spelled out today to continue your own research. But before we go, what is your final provocative thought for everyone today?
Whether a company's building API platforms for wildfire data, processing billions in European payments, or drilling core samples in Quebec, the raw asset is only half the battle.
Just half.
Right. The true driver of long-term value is the infrastructure, digital or physical, that they build to actually bring that asset to the market. Look for the infrastructure and you'll find the value.
Look for the infrastructure and you'll find the value. Brilliant. Thank you so much for joining us on this deep dive.
It was a pleasure.
Keep reading, keep researching, and we will see you next time.